Hey everyone, hope you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to do Twitter, see what people are talking about on social media, see what people are sharing. I'm going to interject my financial opinions as we go through it. It's going to be finance, commodity, and or wealth building topics for the most part. And we'll dive right in, jump right in. If you want to follow me, it's at finding_finance. And if you want to join our community, it's finding-value.com. You can use the word discount and coupon code. And that's where we dig into individual companies, individual sectors, and I can answer questions directly for you. Giovanni says, from the November OPEC oil market report, the recent increase in global crude inventories is simply due to the typical seasonal trends, particularly the heavy refinery maintenance. As you look at 2023, you can see that we are below the average dramatically between 2017 and 2022. We are also below every single year before that. In some of those years, we had higher oil prices in 2021. We had higher oil prices in 2022, depending on the years. And we have lower inventories with lower oil prices than before, which is very interesting. To me, it sounds and smells and feels like an opportunity to be looking at potential companies if this trend continues, where the inventories continue to drop. And generally speaking, inventories get eaten up, prices start to go higher to stop or slow down those inventory draws. So that's kind of the market drawing down inventory and eventually rising prices. Bank lending in the U.S. is now falling for the first time since 2012. So this is bank lending here, and you can see we've had a pretty big pullback in bank lending. That has occurred other times in history. I think the reasoning behind bank lending is very different than all of the other times in history. All those times in history, these were generally housing-led recessions. Like this one here, and in 1980. Those are all housing-led recessions. Even in 1990, a housing-led recession also here. The only one that wasn't was this one here. But we do have bank lending going down year over year, and I've made some comments on a potential slowdown. And bank lending is generally where it comes from. It's rooted in the lending process, and I think that interest rates are probably at an unsustainable level. And if they continue to hold it there, I think it's going to definitely result in a slowdown. So bank lending is important for credit expansion. It's important for inflation. And from this aspect, we have definitely contracted in bank lending, which is surprising to see. Will the fiscal side, will the deficit spending that the government's doing make up for this? I don't know. That's going to be the challenge. Is it going to make up for it? If it doesn't, then I think interest rates are going to have to fall, and then I think we're going to see increased bank lending, much like the 2000 timeframe. But this time, I do think it's a little bit different because we're not. It's not a hyper supply phase. I think the lending has contracted because the stimulus money brought interest rates to a level that is probably not sustainable for bank lending. And that's exactly what we're seeing. It's not housing-led recessions like all these other ones in history, in my opinion at least. Money quote of the day: forecasts may tell you a great deal about the forecaster. They tell you nothing about the future. And I know a lot of people are trying to forecast recessions. They're trying to forecast slowdowns in the market. And a lot of these people have been wrong for a pretty long period of time. I know the housing bears, a lot of them have been bearish since 2020. None of their forecasts have come true. I am going to remain a bull in housing, and I will continue to see what these recession guys are always talking about. But you got to at least have some sort of time frame to know when you're right and when you're wrong. And I'm pretty sure they're wrong if they've been forecasting a recession in housing or a housing crash since 2020 or even 2019. So I agree with Warren, and I think all you can do is find where the value is in the market, invest where the value is, and then wait for that value to be realized in the market, for the imbalance to be cured, for the market conditions to change in your favor, whatever it is. And that's what value investing is about. It's not about making forecasts, having the forecast be right and making money. It's about finding value, exploiting that value, and then waiting for the market conditions to be ripe for that value to be realized. Only one of these people will truly get rich. Slow and steady gains, get rich quick. You can see all the people in the get rich quick. Another thing that get rich quick mentality has is that they chase price performance. It's all about FOMO. They're just running from one asset to another, chasing performance to try to get rich quick. They don't actually understand the value of anything. They're just trying to chase price performance. And I'm not saying slow and steady gains is the way to go necessarily, because you can get explosive returns in very short periods of time. What I would say would be the right one is buy the patterns and buy where the value is. And it's possible that you could get rich quick, depending on how strong the market conditions change in your favor, or how strong the company and breakout is and all that stuff. But for the most part, chase value, chase patterns, don't chase price performance and chase price movement. At least that's the way I look at it. Oil execs have been buying and tech execs have been selling while investors are doing the opposite. ExxonMobil insider trader alert. Board of directors member Jeffrey Ubben bought $250,000 of ZOM shares last week or 250,000 shares of ZOM worth 26.5 million. Now that's some conviction there, guys. that's a lot there. Yeah, and I have been seeing some insiders start to sell in the tech areas and even in the banking areas. You're starting to see Jamie Dimon and some of these other Sophie execs offloading shares. Coming on down, salary increases are not keeping up with the cost of living increases per JP Morgan. Yeah, I probably could have easily guessed that. Merit increases are typically 3-4%. If you've got a really good merit increase, maybe 6. I think inflation's over 10 using shadowstats.com. I don't think anyone's really keeping up with inflation unless they're job hopping to some degree. NASDAQ update, market cycle psychology overlap. Scary, isn't it? So here's the market psychology overlap as it comes on up. And then we've got our potential move lower that could impact the NASDAQ. It does match that pretty well. And with an increasing interest rate environment, I would expect the NASDAQ to run into some pretty stiff headwinds as the pricing gets revalued for those increased interest rates. So I do think that we could potentially be in the bull trap, back to normal thinking. Maybe there is a pullback. Now, a lot of people think that because there's a pullback that is 100% related to a recession, and it could be related to a recession, or it's related to increasing interest rates, which is going to weigh heavily on the market. Or it could be both of those things together. We could get a recession slowdown and increasing interest rates, which is really going to impact these high growth companies and stocks and the valuation of those stocks. Actually, there are still buyers of U.S. Treasuries. It's called American individuals who purchased the most U.S. Treasuries in the past 5 quarters at nearly $1.5 trillion. Americans are the new U.S. Treasury bag holders, is what he says. So a lot of individuals, I guess, are loading up in Treasuries, and I think there's some people who are skeptical of where the interest rates could potentially go in the future. And they think that higher interest rates could come in the future, which would mean that the people who are buying today could be sitting on losses in the future if those rates continue to go higher. FOMC members keep saying they need to see meaningful progress on inflation, not just 3-4 months of good results. But their favorite measure, the core PCE, has been declining for 13 months now. Meanwhile, we've had unemployment rise 0.5% in the last 3 months. When does this mandate flip? And that is interesting because you've got the core PCE coming down, unemployment's going up, when do they flip their mandate? When do they start to see meaningful progress against the inflation? And I don't know. It's up to people now who are controlling this um, measuring stick and when they're going to flip their stance on things. So it's driven by humans now. It's not a free market. Breaking tech relative to small caps just hit the highest level ever seen. This ratio is higher than even the peak of the dot-com bubble. What makes us think that having a valuation of the NASDAQ versus some of the small caps, what makes you think this doesn't correct lower? This is higher than the peak of the dot-com bubble. So we're in a bubble. It's just when is this thing going to pop? At least that's kind of how I look at it. Housing market inventory has recovered slightly, but remains a major issue. Currently, housing inventory is still 37% below the long-term average, according to our boy Reventure. Now he says the inventory down from 37% long-term norms. He took long-term as 2016, and I went back and I looked at data further back. This goes all the way back to 2007, because I always think, roughly speaking, about 6 months of inventory. Each month is about 400,000. 6 times 400,000 puts us at about 2.5 million. That's kind of the average, about 2.5 million, 2 to 2.5 million. This is a good solid market in 2012, 2013, 2014. That's a well-balanced market. The number he used is 1.1 million. So it's not 37% from long-term norms. It's actually far below that because the long-term norms is really 2.3 million. When you calculate what that is from the norm to actually get a more realistic number, it'd be 737,000 divided by about, I'll do 3 million. And that is 32% of where it should be. If you minus it by 1, it's 68% below the long-term norm. So it's not 37%, it's actually 68% below the long-term norm of where we get a balanced market. A lot of this guy's information is jaded, in my opinion, and is giving a false sense of value that it's below. There's a lot of things that he does, like he'll use a percent here, and he uses the wrong long-term norm. That's not the average. The average is about 2.3 million. It's not 1.1 million. And a lot of the data that he shares is, I don't know, I don't like the way he's sharing this because I think the way that he even named that, he said inventory down by 37% from long-term norms. Well, why don't you do it from the average? Why don't you do it from the balanced housing market? I don't understand why he's trying to understate the inventory that we have today. 737,000 is a little less, is right around 2 to 3 months of inventory. That is very low. So I don't know. I don't know why people are trying to project something that isn't towards an average or the long-term average of it. OPEC expects world oil demand to rise almost 1 million barrels per day more than non-OPEC supply in 2024. So OPEC November oil market, they raised it by 0.02, 2.46 million barrels per day for 2023. And 2024 is unchanged at 2.25 million barrels per day, increased demand growth. So oil is expecting to grow quite dramatically coming up this year and next year. And it's going to be growing at a faster pace than what non-OPEC can produce. So now it's up to OPEC, and I don't know if they've got the barrels to produce that amount of oil in terms of the delta. Higher prices probably is what I'm guessing. Have shown I caught the lows in 2020 for stock market, commodities, gold, uranium, etc. Plus gold August 2020 top, oil low in 2023, stock market top, da 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 da. Below, I called the top for copper back in early of 2022. So he thinks it's a potential top in copper. What this could mean is that we get inflation with economic slowdown, which is a potential possibility. And I know he's calling for a big move up in gold. So what that would mean is inflationary. It means a stagflation. You get slowdown in GDP and a big move in inflation. That very well could be the case. Very well could be the case. I do respect his opinions, and you can obviously tell I share a lot of his tweets, and maybe we get a pullback. I know a lot of people are probably going to think, hey, we're going to get a pullback in copper, that inflation is going to come back, and we're going to get this big crash. I don't know about that. We'll have to wait and see. Lynn Alden says hard landing, no. Soft landing, no. Emerging market style landing, yes. Hard for me to see how a hard landing is even possible with a 7% budget deficit. And that's coming from Joseph Wang. And that's what I talk about, a potential slowdown. And the slowdown could be felt in real terms, but not in nominal terms. And that's what they mean by an emerging market style landing. You get a contraction in GDP, just like copper is showing us could potentially occur. But that doesn't mean you get a hard landing or a soft landing or any of these landings where that we're used to historically, where the market actually contracts and the prices go down. What could occur is that we have prices still go up, but we contract GDP at the same time, which is stagflation. And I think that's what a lot of people are looking for, that understand the markets and understand emerging markets. That's why Lynn and Harris Kupperman, they're both looking for something that I think most people don't have on the radar. And that's why I'm so reluctant to state about, to talk too in detail about this quote recession, whatever people are talking about, because it's like, prices can still go up even though GDP can contract, much like emerging market stuff. So again, we'll see what happens. And these fiscal deficits that are being run right now. The breadth of the GDP signals an impending recession. So other people are seeing recessionary signals. And again, it depends on that emerging markets, slowdown. We could have nominal prices go up, real GDP go down, and still it's almost like a hidden recession. And I think that's kind of what we're going through. Copper, China tightens grip on copper, key to world's energy transition. CRU sees copper demand in China growing 5% this year, while Goldman Sachs named copper as one of its top commodity picks for next year on a robust green demand environment. So we've got Grady thinking that copper could potentially decline here. We think, maybe a potential slowdown in the markets. And then we've got other people talking about how bullish the demand for physical copper is. And you can see it's increasing by 5%, at least their projections are. Who's going to be right? Whose forecast is going to be right? And what did Buffett say about forecasts? All you can do is the forecast tells about the forecaster, not necessarily an accurate prediction on the future. And that's where everyone's trying to make these projections. I read all these articles. A lot of them conflict with each other. I look at the charts. A lot of the charts show bullish formations, so I just go with what the charts are telling me. The narrative is all over the place for what could potentially occur over the next year or two. 66% of U.S. millionaires are 60 to 79 years old. 23% of U.S. millionaires are 50 to 59. That is a big chunk there. It looks like that, 89, 90% or so. The remaining population of U.S. millionaires are 40 years or younger. So kind of interesting statistics, and it's quite obvious to me that investing and how old you are has a big impact on what your net worth is going to be. Because they've been saving for all that time and letting it compound. Here's Wheaton Precious Metals. He's got a chart up. It says posted on a huge purple bull flag breakout and backtest for the big dog precious metals royalty company Wheaton. Wheaton's a sector leader, so what it does is important. Now again, backtesting the green parabolic base trend line, shoulder, head, shoulder, breakout, flag pattern. This depending on what. This is on a 12-year or a 12-month, I think, chart. This is a 12-year chart on a monthly chart pattern. If you look at a shorter term time frame, it's a cup and handle as well, but it looks really good. It says this huge bullish reversal was one of many, many clues the low was in back in 2020 right here. Posted that orange back test for oil would most probably hold. It did. Oil rising again is another sign second inflationary phase is coming. And oil rising big often starts off recessions. At least 250 to 300 oil during this bull market is what he's projecting. The commodities bull is a lifetime opportunity. And hopefully everyone takes advantage of it. Okay, we're zooming back in here. This one of many charts I used to call the commodities bear market low back in 2020. When second pink head and shoulders broke down, I understood that the massive symmetrical and stylish blue head and shoulders probably was going to play out. And there it is. That's a slingshot, false breakout slingshot all the way up. And hopefully we can get another big move out of oil. In gold we trust. This is Ronnie Stoferle. He says, our gold price model predicts 4,821 for 2030 is what he's got. A big move upward, which means maybe that's an inflationary move, much like from 2000 to 2010, 2011. Big inflationary move is something similar that could potentially occur in the future here. And if he's projecting out to 2030, that's probably the overall, like oil markets might slow down 2028, 2027 or something like that. And then you get a stimulus move after that for another year or two. At least that's what occurred in 2008-9. This was the stimulus move here, and this was the other move before it. In the commodity cycle, we're very low right now, so this all kind of makes sense. This commodity bull market will be the greatest opportunity in your lifetime to get out of the rat race, says Grady. Here we are, yet one more evidence of where to be. Oil companies breaking out and backtesting versus general equities. And this is XLE versus SPY. It's a 15-year bullish falling wedge. False breakout to the downside. We've come all the way up, and we just broke out. We're doing a retest in this ratio, and then we'll probably keep working our way on higher. That is XLE, the oil and gas companies, versus the U.S. stock market. That's also looking quite good. And that's where I'm going to end it. That's what we've got for today, guys. Give me a thumb up for the content. Subscribe to the channel if you guys would like. Use the word discount coupon code. We've got a Sunday 5 p.m. Mountain Standard Time question and answer session coming up this weekend. If you're a member, you can ask me whatever questions we got. I'll probably lead in with some information for all the investors or potential, members of the community. I'll lead in with something. Haven't figured it out yet, but I'll find something that we can talk about, and or potential setups in the market that I really like, because there are some that are potentially forming right now. So that's what I've got for today, guys. Hope you have a good day. This is Finding Value.